Hello everyone, welcome back to another Quantower video. In today's video, we're going to discuss something known as the imbalance in the footprint charts. So you would have heard a lot about this. So we'll first get into the basics and then dwell deep into how we can use this imbalance so that you have a general understanding what we're looking for when we're talking about imbalance. Okay. So as the name suggests, imbalance is a sort of literally an imbalance between the buyers and the sellers. In actual terminology, it is the imbalance between the market buyers and the sellers. So if you're not aware of what market buyers or sellers are and what they mean, you can go into my past videos. There is one of my videos in which I've done a lot about basics. Okay, so just to start off with, you have passive buyers and sellers that you can see on the market depth on your broker terminal. So there are the passive buyers and the sellers. What the footprint essentially does is display all the market buyers and sellers that are the buyers and the sellers that are taking off these contracts that you see on the market depth or your broker terminal. So if you've gone to any contract for, let's say for example, Bank Nifty futures, and you've seen your broker terminal, so you see a depth of market in which you see last 5 bid and ask. Okay, so that is nothing else but passive orders. So why do we pay so much attention to market orders is because these orders are the ones that move the market. Having said that, it doesn't mean that passive orders are not important. They are to build positions, and it is a major tool that is used by a lot of big institutions and big money. So what we want to do is get a track of where the aggression is and where the accumulation of the distribution is. So this particular term that we use, that is imbalance, is because of the fact that one side has been more aggressive than the other side. Okay, so now we will discuss what I have on the chart. So this is Bank Nifty 15-minute and a 5-minute chart. So don't get intimidated. I'll just explain what I have on the chart. We'll get a simpler chart as well if you want. So what this chart is, again, basic candlestick so that everybody can see what is happening. We'll just expand this. Okay, so you would see that I do not have the numbers being displayed. Is because of the tick size that I've chosen. I'll go, not to worry, I'll go into each and every one of the details that we have here. Okay, so on the left side over here, if you look closely, you can see the volume profile. Okay, so this is the volume profile for that is for this particular bar. So I can see the volume that is transacted and the areas where the volume has transacted the most. Okay, so when I look at this 15-minute bar, you can see that the numbers are black in color. So just for the sake of understanding, and we can get this out of the way, I'll just shift it to a lighter color so that you can see it. Okay, so now when I look at this bar, even if I don't look at the numbers, I can straight away see that this is a cluster. I will just get my marker on. So this is a cluster where I see a lot of volume that is transacted in this 15-minute bar that happened at 1500 hours. Now why am I circling this place is because look at the volume. Look at this color that we've set 18,717 contracts. That's a big number. Okay, and when we're looking at this, on the left side I see the volume, and on the right side I can see the delta. Okay, so I see that the majority of the selling, again, this is the zone that has the majority of the volume and the majority of the delta, and at this point the sellers were more aggressive and the market moved down. Okay, so why am I explaining this? This is just a concept so that even when you're not looking at the numbers, you're looking at a chart or anything, the numbers can be intimidating at some times. But when you look at this 15-minute chart and this bar hasn't formed, this is what my you get an idea of what is happening in the market. Okay, so I look at this area and I realize that there's a lot of volume that is transacted, yes, and the sellers are primarily associated or located in this area. Now let's get into what imbalance is. Okay, so when you look at these places, I just delete this. So when you look at these colors, that magenta that are coming up separately, these are the places where there is an imbalance. So what I have done is I have set an imbalance number. So whenever, and the other thing that you do is you look at the sellers against the buyers. The left side is the market sellers and the right side is the market buyers. Okay, so unlike a bid ask that you see on a broker terminal, in which you see something like this, bid and ask, if you go and see over there, buyers or sellers or whatever. So if for example you have a 50 over here price, you will have a 51, that is the seller will have a higher price than the buyer, and so on, and you will have the numbers written over here. So this is the price that would be written, 50 and 51, let's say, and the numbers would be there. For example, there are about 100 contracts here and 200 contracts here. So something like this would be written on your depth of market that you have on the broker terminal. What you see over here are the market buy and sell orders. Okay, so on the left side you have the sellers, and on the right side you have the buyers. Now when the market is actually, the auction is taking place, it's really difficult to read these numbers. So what you do is you set a percentage. So whenever I see a percentage, let's say 300%, 3 times, 4 times, 5 times or 6 times of the opposite side. So because the price is, like we just discussed, the price is on the higher side on the seller side and lower side on the buyer side. That is why we look at it diagonally. Okay, so the exact price is actually, a seller is located here and a buyer is located here, and that is how the entire auction works. If you go to any place, you would have a person who wants to sell you something, he will always quote you higher, and a buyer, if he wants to buy something from you, he always wants to buy it cheaper. So there's always this diagonal lookout everywhere in a buyer seller configuration, and that is why it is looked at it like this. Okay, so now what we do is we set a percentage. So whenever I see a sell transaction that is, let's say 300% or 400% or 500% greater than the buyer transaction, I wanted to see it colored in some color, any color. So I have put it magenta over here. Okay, similarly, if I see something like this on the buy side, okay, I will have it blue or cyan in color, that is being displayed over here. So when I look at the chart, even if I don't look at the numbers, where it is quite difficult, even if I contract it like this, okay, immediately I see that this place is showing me delta, where the selling transaction is more. Now if I expand it again, so you would have seen that the sellers are here and the delta of course has been plotted here. And when this is what is imbalance, okay, the percentage that we just said, we will go into the settings and a little later. And what we'll do is we will first understand how we look into these charts. Okay, so for example, over here you see one buy imbalance. Now I don't want every imbalance to be plotted like a zone like we have over here. What I want is, let's say if I have 3 counts that are consecutive in nature. For example, I do have 6 counts over here. Okay, but what if I had 6 or 3 or 4, whichever number of these counts, one after the other? They're called stacked. Okay, so stacked means they are together, they're positioned together. And whenever something like this happens, so if you see over here, this is a stacked imbalance on the buy side, and since these 4 levels are together, I have a zone that is plotted. Now what is the importance of having these stacked imbalances, and why do we plot zones from there? So it can happen at 1 or 2 levels that there is some orders that have come and it caused a sell imbalance. It can happen all the time. What I want to know is, whenever I have a stacked imbalance, that is a series of this happening, what is essentially happening is there is a big order on the buy side. They can be stops or anything that have triggered and moved the market all these 5 ticks or 5 rows above and gone to some other price. How does that happen? Again, let's go back to the I have explained this a lot of time in my videos, but since for people who are a little new or beginners, I will explain again. So we will go, and again on a broker terminal, if you look at your depth of market, it will be something like this. So I will not write the prices here. The prices, again, the selling is generally little higher than the buying side. So let's say we have 50 contracts here, 100 contracts here, 500 contracts here. Now what 600 contracts here. So these are passive buyers, and similarly I'll have passive sellers. Now if the market has to go down all these levels, these all passive buyers or the passive buy contracts or orders have to be absorbed. So let's say a seller who's very aggressive comes in with 5,000 contracts. When he does this, only if he does this will all these strike prices, or I'm sorry, not the strike prices, all these rows or all these orders be absorbed or taken out. Not absorbed is not the right word, but they'll be taken out by this big sell order. So as soon as this 5,000 comes, this will keep going down till it meets its number of 5,000. So let's say there is a number of 3,800 here. So it will go up till this price before this order is filled. Okay, so what this guy, this big guy, has done essentially is he's taken out all these guys. Okay, so when he does this, he's done this because he has a big order. Okay, so because he's a big order, I want to see him on the chart. So how do I see him? When he does something like this, I will see this imbalances pop up. Okay, because he's done it with so much aggression and so much quantity that I see something like this. That is why these stacked imbalances become important. The next step that you can do is you can have this minimum number of volumes also set. Okay, so we will just go into those settings one by one. So now that we've understood what imbalance is and what the ratio is and what stacked imbalances, let's go a little deeper. Okay, now I'll go into the settings so that a lot of people will, I know, will come up with the question, what is the stick size you've kept and what is the percentage you have set. So what I have done here is I have set 60 as my tick size. Again, it is very small. You'll generally see the default value of 200 or 120. Again, it depends on you, but I have set it like this because I am not interested in numbers. I am interested in the zones that I just spoke about. These numbers are very difficult to read. Okay, so whenever there is a big contract or a big value, I will straight away see it pop up in the form of the volume profile that I have plotted behind. Okay, and because the tick size is really small, what I've done is I have set it the imbalance ratio, that is the difference between these two, as 600%, or 6 is the value that I've set over here, and the zones that I want to see, that is stacked zones, is 4. Why have I done this? Because I have this value tick size as 60. Let's say I have it as 200. So what it will do is I'll just show you what happens. You look at these charts simply. So it will now look at more number of ticks. So 200 ticks, that is, it is plotting for almost 10 to 10 points for every row like this. So now, since the tick size is increased, obviously the imbalances count will decrease, because when I had 4 or 5 of them, when I had a smaller tick size, I will get that setting page again. Okay, so when I had a smaller tick size, I hope you're understanding this. When I have a smaller tick size, what it does is it creates a more number of rows. So that is why since the tick size over here, if it's more, I will generally have it set to again back to 3. And again, it's your personal choice, and this can be again 3. So this is the standard that I generally use if I have a tick size of more than 180, 200 for Bank Nifty during highly volatile periods, and I'm using something like this. Then I'll send it to set it to 3 and 3. This is the default on Quantower. But if I have something like what I have set, you can go ahead and choose 60. Again, your wish. Having a tick size of 200 is also fine. If I have something set up something like this, because I want to see the since I have the volume profile set behind, I have something like this set on the chart. Okay, so now that we are done with the part where we have the settings done, now you will generally see these imbalance zones working quite fine. Okay, by quite fine I mean you will generally get 40 on a Bank Nifty chart on a 5-minute. This is a 15-minute. Even on a 5-minute, on a 15-minute, you generally get 50 to 80 points move, a retracement of sorts. For example, whenever it touches first, you can see good retracement and a good pullback from that place. Okay, so now let's get into how you can use these imbalance zones. So when I see these imbalance zones, the stacked imbalance that we just spoke about on the top in that are red in color, what does this mean? This means that, like we just discussed, there is aggression by the buy side. Okay, now similarly, when I see something like this and blue in color, this means there is aggression on the I'm sorry, this is aggression on the sell side, red in color, and this is aggression on the buy side. Now let's go a little deeper. So over here everything is normal because I see sell side aggression and the market is approaching here. Sometimes what I'll see is that this magenta is sometimes blue in color. That means I'm approaching an area where I had seen aggression by the sellers, but the aggression failed, and that is why this is continued. This will continue till the time of future intersection, or the bar closes above this. Okay, so when I see a blue in color on top, that means there was an aggression by the buy side, and that aggression was not good enough to take the market up. The market fell down. So what does that mean? It means an absorption that has taken place. So if I see the other way around, for example, if I was approaching it like I just said, and I see blue, it was not aggression and absorption. So why am I saying this? You need to know what you are trading when you get into a trade. Okay, so when I'm, for example, planning a trade, when it approaches this area, I know there was an aggression shown by the buyers some point in the day, and I can expect these buyers to come up and show up again whenever they are, and take a counter trade. So you can see this is the place, exactly the place where the buying, I mean the selling, that intense selling that happened on Friday stopped, and the price moved up again. Now the other thing that you want to look into when you are looking at this stacked imbalances is the that is the outcome or the result. The effort was a result that we keep talking in volume spread analysis, is that the effort that was there on this particular bar, that is the aggression and the buying imbalance that was there, what did it cause? Did it cause a good movement or just 60-80 points? So on back nifty, 60-80 points is not enough for me to treat it as a support zone. So when something like this happens, okay, so you look at the move that transpired after this, so I can of course expect a 80 to 100 point bounce of this point, if not less. Okay, so when the market comes here, it as we just saw, it creates a good opportunity, you can see, and we'll dwell into how you can trade off it a little later, or maybe in the next session if we have time. So when you see these stacked imbalances together like this, what do you do then? I generally prefer it closer to the last one, because this would have generally happened on a single bar or single big aggressive bar, and I want to see the place where the selling started from. So this is within the area, like we just discussed. Somebody hit the bid, like we call it, hitting the bid with a lot of volume at this at the time of selling when this happened. So within a bar, this is most probably case of 1 bars or 2 bars creating so many imbalances. So the first one, although in most of the times you will get like you see overhead, you get a 15-point bounce, but this one you do get almost 80-point bounce like this. But I generally prefer, when I have 3 of them together, I would prefer the on the selling side, the bar that is, or the stacked imbalance that is the topmost. Similarly on the buy imbalance side, when I have 2 or 3 stacked together, I would want to prefer the lowest ones. Just remember this, this is what I tend to do. So if you want to see where the selling has been caused from, this is, I think, a really long time back. So it holds all the time. So like I said, it has been caused by 1 bar. This 1 bar, these 2 imbalances have been caused by one of these bars, and then one over here. Okay, so since they are all together, I would rather prefer the top one, because this is from the same bar and this is again from a different bar. And I think this bar it took a little bit of resistance, and it did come close in the opening 5 or 15 minutes, took a sort of a resistance, and this next shot again it took up. So I would prefer something like this. Now when it approaches the imbalance, again, the smaller the time frame, the smaller the targets, the bigger the time frame, the bigger the targets. Okay, when we approach this zone the first time, what I want to see is again, since it is a trend day, it is difficult the first time, but you can plan it because you have a zone and you have a strategy in mind. And of course, when you're trading these imbalances, your stop losses need to be really small, not more than 40-50 points, because if this zone has to really hold, it will hold. You can get really good 1:2 trades, that is for a 40-point move. You will just you will easily get an 80-point move to the downside or the other side. Okay, now when it approaches here, what I want to see is something like this. I keep talking about is a lot of volume cluster over here, and if you look at it closely, what you see, a lot of buyers that are getting trapped. Okay, so these are the buyers, either the stops or the new buyers that wanted to break, and the market and the bar has closed below that cluster, that volume cluster, not on this bar but this bar, and it has taken out, if you look at this place, all these buyers. Okay, and the next time there is an interaction is at this level, if you look at it closely. Okay, so again, if you look at the number of points that you're looking at when you enter somewhere here, and 730, and your target is let's say 40 points, so all you're looking is for 690 to, or maybe double the this thing, so it makes it 650 to somewhere here. Okay, when the bar approaches this place, I do see another interaction over here. So if you look at it, this is the place I would generally trail my trade somewhere close to break even. Why do I say that? Although the bar did move down, if you look at this place closely, what has happened is, as soon as the bar approached this place, after this, of course, I was expecting a sort of a bump move down, and over here I see an interaction between the buyers and the sellers again taking place a lot of sellers getting trapped over here. Okay, so this is the same situation. So it could have very well taken a support here and again try to break this if it had to, and or else what happened over here is quite normal. So that is why you have to keep looking at the charts and keep looking at the numbers. They will not happen exactly like you are planning sometimes. And if you look at this zone, what I was talking about, you see a good volume cluster. So obviously there are buyers that are stepping in at this zone, and they're not some new buyers. They've been here since the last 3 15-minute bars over here. If you look at it, the entire cluster is here, and when this breaks, I know for sure that it is going to go down a lot. It is going to go down to the next cluster that I have, which is somewhere here. Look at these trapped, or this imbalance zone that I have. Okay, again you can look in footprint charts. You can look at it in real time and get to know what is happening. Okay, so this is how you can trade these imbalance zones whenever they approach a particular zone, and look for a confirmation like I just spoke. So if you look at this level, and the first time this happened, this happens really fast. Okay, and now this, let's consider this imbalance for the sake of understanding what we're talking, and we'll close the session here. So when the first time this approaches here, you do see a lot of buying step in, or the buying or the buyers getting trapped. You look at the volume interaction, there is a lot of, like we just spoke, interaction between the buyers and the sellers taking place. So this is a price where the sellers have now started getting interesting. If you look at the previous bars, look at these trend bars that go up, and look at the way the bars have been going with little volume. Then when you see clusters like this is an indication that the sellers are now interested. But you need to see a confirmation of sorts before you enter a trade. Okay, so the first one, it wouldn't have been a bad trade actually if you would have tried to short the market over here as well with a small stop loss. It wouldn't have been a bad trade. The only thing that is stopping you is that again, this zone, I would have preferred the third zone, and this is a trend day. On a balancing day, this would have been a very good trade. If you see something like this, you would have more often than not, and with a higher probability, got a pullback at least till this area. Okay, but since it was a trend day, there were a lot of stops that were getting triggered. We see another one go up and then finally eventually fail. Okay, so it is nothing harmful, or there is nothing bad if you would have planned a trade somewhere here, failed, and planned another one somewhere here. Okay, so again, it is too close to each other. It's actually a half an hour apart, but this wasn't a bad place either. Of course, this is no place where I see any confirmation. So what I'm talking about is this place, there is absolutely no trade. I don't see any cluster or any sellers that are stepping in. The other side needs to step in for me to take any trade off. Okay, this is again a place where some selling steps in, but it is very fast, and this is the first time I see something. And generally in a trend day, you should wait for about 30 to 45 minutes for the market to show you that now it is starting to balance. What do I mean by balance? Generally on a trend day, what will happen is this is 10:30, 10:45. Okay, so on a trend day, before 1100 hours, do not expect some great pullback, because the market is going to keep continuing and then start doing something like this, and maybe in the later session again try something like this. So this is the zone you want to try this imbalance fading on a 10-day. Okay, what is rather better is, if you want to go for an aggressive trade, if you go to a smaller time frame, what you can do on a trend day is, when you see something like this and you've seen in the first 15-20 minutes or half an hour the market going, if you see an imbalance on the buy side that has popped up, you want to take this trade. Okay, wait for the imbalance zone to come over here, the price to come here, and then take a trade on a trend day. Okay, now on a balancing day, the days that we had before, if you try and do this, if you try and take aggression on, you're going to fail. Okay, so that is the difference between taking these sort of trades. Okay, so a pullback trade is what you're looking for on trend day, and a fade trade, something like this, is what you're looking for on a balancing day. So on this day, which trades would have actually been of good significance is where you would have seen the buy side imbalances and the market going to those levels and then taking up. So you can go on a 5-minute chart like I have here, and you can see, if you can plot those buy imbalances or see those buy imbalances and backtest them. If you could find them on a Friday chart, do this over the weekend. And if you do not see buy imbalances, you can go ahead and see the way I just we just discussed. So even if you don't see a buy imbalance, you can see these sellers getting trapped here. You can see on this 15 minute, the majority of the volume is here, the sellers getting trapped here, and this is a level that I carry forward whenever the market comes here next. Okay, so you can have these levels plotted even if the imbalance is not showing up on the chart. So let's see something like this. Now when the market does finally approach this part and I see this cluster over here, it doesn't give me a chance like we just spoke about for a confirmation. And look what happens. There is an interaction that has taken place here. So these are the buyers that would have tried to defend the market and take the market up, but what eventually happens, it breaks down and goes down, and in fact it closes exactly at this point. So this point now becomes of really good significance, this 47,600 to 620, and it's a carry forward level. And this is how you can mark these levels on a bigger time frame and use them, and use this particular concept in your day-to-day trading. So hopefully this session was of some help to you guys. Until next time, thank you. Bye bye.